What is hedging for? Managing market volatility. Imagine trying to keep your balance on a boat during a storm. You wouldn't just stand still and hope for the best. Instead, you'd use tools and techniques to stay steady. That's what hedging does for your investment portfolio during times of market ups and downs. It acts like an insurance policy, helping protect your money from big losses when markets become unpredictable. For seniors, who often depend on their investments for income and have less time to recover from setbacks, hedging can be a smart way to keep their savings safe. Hedging involves taking actions to offset potential losses in your investments. One common method is using options contracts. These are agreements that give you the right, but not the obligation, to buy or sell an asset at a set price within a certain time. For example, a put option allows you to sell shares at a specific price, which can limit your losses if the market drops sharply. This way, you can protect your stocks without having to sell them at a loss. Another way to hedge is by diversifying your investments across different asset classes. Instead of putting all your money into stocks, spreading it among bonds, cash, and other assets reduces the risk of a big hit from one market. Bonds and cash tend to be less volatile than stocks, so they can act as a cushion during market downturns. Holding safer, short-term bonds or cash reserves is especially helpful for seniors who need quick access to funds for living expenses. Having a portion of your portfolio in these stable assets can prevent you from having to sell investments at a bad time. Hedging does come with some costs. For example, buying options requires paying premiums, which are fees for the right to buy or sell at a certain price. Also, some hedging strategies might limit your upside potential if the market moves in your favor. That's why it's important for seniors to focus on the most volatile parts of their portfolios and consider their personal comfort with risk and how long they have before needing the money. Practical strategies for managing market volatility include dividing your investments into different buckets based on when you'll need the money. For instance, keeping 1 or 2 years of expenses in cash or short-term bonds helps ensure you won't be forced to sell stocks during a market slump. This approach reduces the chance of losing money just when you need it most. During volatile times, it's best to stick with your plan rather than making impulsive moves that could lock in losses. Also, delaying Social Security benefits can provide a guaranteed income boost, offering extra protection against market swings and inflation. In short, hedging is about using specific techniques and tools to protect your investments from big losses during uncertain market conditions. It involves strategies like options, diversification, and holding stable assets. For seniors, these methods help preserve their savings and give peace of mind, knowing they have a plan in place to handle market ups and downs. It's all about balancing risk and reward to keep your financial future secure.